time now to welcome on board a market guest. We have Mr. Ajay Srivastava, the CEO at Dimensions Corporate Financial Service, to talk to us about the market mood right now. Ajay, hi, that's exactly the first question. What's the market mood? Because if you look at the headline index, it's very sideways. We talk to people, they say that there's still, it's getting more difficult incrementally to find ideas in the market. What are you doing currently?
Good morning, everybody. I think, this is all markets are difficult market. When the market is down, you wonder when you have to invest. When the market is up, you wonder, are you investing on the top? So I think life for all of us is not easy to start with. But as I keep saying always that if you got a vision on the market, you need to find ways and spots which are the trending outside. You don't need to go to the laggards. There are lots of sectors which are trending up, which are consolidated, and which are going to see the leg up post the election. So I don't think one has to be very, very scared in terms of where the market heights are or that there is so many lack of opportunities. Market always gives you chances to invest. Market gives you chances to buy into. And at the end of the day, if you are not as old as I am, you have no choice but to buy today. Therefore, I think one should just take a clear mind and say, past is past, future looks good. We need to find a way to invest. How much to invest, when is a timing issue, a different matter. But to worry about it's a market is on a high, I don't think we need to be worried about it. Look the right sectors and you should be fine.
Excellent point. With age comes experience, and with experience comes precision. I think, this is the only game when you get better with age, is it not? So it's in your favor. Your precision is only increasing, is it not, Ajay?
I wish so. I wish, doctors, I find that they get more money as they become older. We get, you won't find a trader in New York which is over 35 years old, by the way. So I think we get a little bit, in fact, we have a disadvantage because we know the history of share prices and therefore we get bogged down with it. The guy in my office who just walked in this year, joined this year, he doesn't know what happened 15 years back and therefore he comes with no baggage. So I think to some extent, our experience, gray hair are a disadvantage. The only advantage is seen so much, done so much. Scare is something which doesn't go into us. We don't fear the market. We love the markets and embrace the market. I think that's the only difference perhaps that comes with age, that you tend to know that the market will surprise you. Market will overguess you. Market is smarter than you. And I think once that thought is in your mind, you are much better off investing.
There is a proverb, or I'd say adage on the street, that there are old traders and there are bold traders, but there are no old bold traders, right? But then, of course, Buffett made bulk of the money after 50, right? So the best of the returns are back-ended. There's a specific area I want your thoughts on, Ajay, because it comes out of experience. We've seen PSUs, Indian PSU stocks were never graded as investment grade. They were just point A to point B and then exit kind of plays. Over the years, their business models have become more robust and efficiencies are clearly visible in numbers. But valuations did become a question mark because they shot up in a very short span of time. During 2024, if it does give a chance to correct for PSUs, the most popular ones across sectors, 30-40%, would you be comfortable getting back in there for 3 to 5 year view?
I think getting back, I don't know because we are already invested in it. I think some sectors you have no choice but to go into PSUs, like defense sector. We don't have any big defense company in this country, at least this point of time. Some may emerge over time, a Bharat Forge may come in or a smaller setup may go. But if you want to buy defense, you have no choice but to buy the PSU companies. If you want to buy oil marketing companies, which have a huge reach in this country, you have no choice but to buy PSUs. If you look at power stocks at this point of time, the man who sits on the highest power capacity is a PSU stock. If you look at transmission companies, you don't have an option but to buy into a PSU transmission company because there is none which exists in the private sector. There's a REIT which exists in the private sector of transmission company integrate, but company don't exist. So, the debate whether we can buy or not is a choice that if you want to be in the sectors, transmission, defense, big power at the end of the day, you have, and say oil retailing, these 4 sectors, you have no choice. Yes, you have a choice to buy a PSU bank or don't buy a PSU bank. But if you look at these 4-5 sectors, you have no choice. So I think my guess is that, these sectors will have just seen the first run up after almost 2 decades. We have seen PSUs not performing for 2 decades or maybe more. So I think this is the first leg and people have got really said, it's the new high. But I think it'll go higher. I think PSUs will get more traction, certainly in the 5 sectors we have spoken about just now, because simply there is none which exist and there is no competition. And anybody from overseas wants to come into India, in these five sectors has to go to the PSUs. So my guess is that these five, six sectors, including say power finance, now that's a unique niche in this country, which again with the PSUs, you can't go anywhere else, PSUs. So you can pick and choose. You want to ignore the sectors? Sure. You want to be in the sectors? PSU is your game. And I think they will give a much better return because for one reason, the dividend policy is not specified. So with the dividend yield, these become very attractive buys. And debt is not their concern. They are government guaranteed, so they can borrow the best rates. Professional management, well, one can say yes to some extent, but OMCs would say it's not professionally managed because the rates are governed by the government at this point of time. Having said so, I think overall it looks positive. And with the new government coming in, I guess is that there will be more divestments and more accountability. Boards will get professionalized. So it's in a good wicket to be at least in the five sectors.
A good decade to be in the PSUs in the five sectors that you spoke about as well: defense, power finance, OMCs, all of that coming in, Ajay. But I also want your thoughts on specifically when you compare PSU banks with private banks. What are your thoughts that, and over there in terms of private banks, would you be looking at any of these big banks coming in, specifically something like an HDFC Axis? Seems like we've not seen much of a performance there as well from these large banks.
See, we don't have much banks in our portfolio, neither in advisory at this point of time, for the simple reason that these are behemoths who have lost to the competition. They did not invest enough. And once the RBI removed the umbrella of no new licenses and the fintechs came in and NBFCs got a little bit leg, these banks were caught wanting. Of course, leave aside HDFC Bank, which is a disaster to start with. The merger was a disaster. So leave that aside. It'll take its time to come up. It's a good institution, but it'll take its own time. But by and large, I think this is one sector which has lagged behind because the RBI gave them such a comfort of no competition that they never thought of the consumer at the end of the day. And that is what fintechs came and did it. Of course, fintechs under a cosh as well. But the point remains that the core constituency of the bank was keep your money cheap and lend at leisure, including government securities. So you kept a fixed deposit at 5-6%. They were putting in government treasury at 7-8%. Your CASA was next to nothing. I think that model is under threat at this point of time. And therefore, banks will see a consistent problem because the raw material, the cheap raw material, is now becoming more expensive. Just like any manufacturing company, if the raw material goes up, your margins tend to shrink because customer can get his options. So I think the banks are going to have a problem of their basic raw material, cheap deposits. Whittling down, it cannot disappear. People love to put money in the bank, but it will whittle down. Therefore, I would tend to believe that our industrial sectors, our equity-linked sectors would be far better choices than banks at this point of time in terms of return on capital.
Ajay, you may have observed that big money seem to be positioning in some of the very beaten down kind of NBFCs last few weeks. Just yesterday, Florentry, along with Brookfield, has decided to put in a big chunk in Indostar, that CV financier, the bombed out. Last week, we saw 4,000 crore come in the rights issue of India Bull Housing. Would you be keen to look at some of these kind of names or stories, or you'll be wary of them?
No, we're not. We've moved into but very large NBFCs. We are not moving to small NBFCs. And the reason we move large NBFCs is, as I think the climate for their ability to raise money directly from the public is very, very good at this point of time. Therefore, if you see some of the leading funds, one company raised 5,000 crore NCDs in exactly 2 days from the market. So, for the larger NBFCs who can diversify away from the bank their funding sources, it's going to be a very good time for the next 2 to 3 years because they have a clean market for themselves. Number two, as the banks start to get out of NBFCs or become a little bit careful, the smaller NBFCs will be in trouble in terms of raising it. If you can raise equity, like you mentioned, I think your NBFC is safe and fine. But if you can't raise equity, we should see lots of consolidation, lots of stress plays happening in the NBFC space. But the top 5 NBFC of this country are very, very good NBFC at this point of time. And I think if one were to put it, rather than putting in the banks, put in the NBFCs because these guys are getting better yields. They can go to give you LAP loans, they can give you commercial vehicle loans, they can give you personal loans and control quite well at this point in time. Banks cannot do that. They are going to rely on industrial loans where the yields are going to be low. So if you look at 4% yields, you have to be NBFCs. Banks will gradually, the yield will shrink to 2.5% at this point of time. And therefore, relatively speaking, the sector of large NBFCs, I think, would do much better for equity returns.
Large NBFCs are better placed and have better sector, return opportunity and potential. But Ajay, what's your take regarding this so-called class of 21 or the new age tech companies that we keep talking about? Because we have seen very divergent kind of situation happening. PB Fintech and Zomato have gone one way. Delivery is also inching up, but you have the likes of Nykaa and now, of course, the Paytm debacle. It's getting very, very diabolical. What should investors do at this point of time with these stocks?
I love your language called diabolical. That's one name I could not give to them, but well, I will carry that one as well. No, I think again back to the same point. We have a lot of investments in these companies. Let's be honest, okay, and you cannot live without them. The key test is there are these monopolies which are emerging in the system, or at least duopolies. Because if you are in a sector which is a monopoly or a duopoly, let's take you spoke, and for disclosure, we have the investment, so it's not a recommendation. You spoke of PV Fintech. Now, in insurance retailing and financial retailing, they're the sole company in the country, really speaking. There's nobody else competing with them. So it's same with the food delivery service, which has pivoted itself to an amazing concept called delivery of product, and they can directly now compete with an Amazon of the world without the backup of all the 7,000 crores of losses. You have to embrace them. You have to invest. When you buy a product today, all of us go instantly to either Swiggy or Zomato because Zomato is listed, you can buy the share. Or you got a Paytm. Paytm is a sad story because I think there is a central bank could have removed the CEO when they found that he was not listening to the advice. Instead of penalizing the CEO and the principal share promoter of the company, they've penalized people in the market. And I think that was a sad story because the CEO should have been just sacked by the RBI. They can remove it. They have the powers to remove a CEO of the bank instantly and override the board of directors and secure the interest of millions of people who use Paytm Bank or the ordinary shareholders. They chose not to. And guess what the guy does? He resigns from the bank, moves to Paytm, which is okay at this point of time. So I think an iconic institution, unique absolutely in terms of market spread. Nowhere in the world you have a comparable payment system as what Paytm has done, but it's a very sad governance story because what the central banker could have done, protect the company and kill the CEO who was delinquent in his job or the board members who were delinquent. They did exactly the opposite. But don't take that as an example. I think this business has a lot more to go. All the new age companies have a real long runways to go to. Yes, some will do better, some will do worse. Some may have pessimism. Zomato was pessimistically priced at 80 rupees not long back, and then of course they picked it up after Blinkit became such a success. I think you have to embrace it, buy it, make it a larger and larger part of your portfolio. That is where your life is. You don't live your life away from Microsoft, or you don't live your life away from Zomato, or go online buying, etc. Why would you leave a portfolio out of it? This is the future. This is the future of your portfolio. So our recommendation to all our people is keep buying, keep investing. Yes, you will face setbacks like a Paytm will be a setback, but that's nothing to do with your model of investing. That's to do with the regulatory model is buy, hold, keep. It's a decade, 2-decade story, what will turn out to be, and it will be a magical story, I can tell you this much.
Okay, a magical story is what you're talking about, at least for these new age tech companies is what you're saying. What's your thought on, the hotel sector as well, the hotel stocks? We've seen a run up coming in. Obviously, a lot of factors that play out for these stocks as well in terms of travel, domestic play, as well as in terms of the religious tourism that we're talking about. Still quite bullish on the hotel stocks?
U, capital Y. That's a three-word answer. I think, again, I keep saying, go back to where the Indian economic story is running. It's a clear K-shaped country at this point of time. The people, we may not like it. We may not, some people may say it's not correct for the country or the poor, but the fact is, when I sit here and decide my equity investment, I look at what's happening. India's rich are getting richer and they're spending their money on experiences. They're not being on product. And it is just, again, back to the beginning. Same issue at NBFCs. Hotels are consolidating. Smaller hotels are giving up to the larger hotel chains. The larger hotel chains are able to extract a price absolutely ridiculous. If you see the summer pricing today, absolutely ridiculous pricing. We have not seen this kind of pricing even last year. So I think hotels, by and large, are on an expansion spree, consolidation spree, and they price their product quite attractively at this point of time. There's economy, there is mid-share, there's superior, whatever you want to say. And best part, competition. There are not many hotel chains coming up in the country. There's standard ones which are getting the bigger and bigger market share, and they're moving into, like you saw, Arma Trails coming in, etc. So they're not sticking to the hotel room. I would say for the next 5 years, it's a golden era for the because hotels, because consolidation will give them enormous power. Lack of competition is huge, and there is a long pipe delay in getting up a new hotel up. It takes 5 years at the end of the day. So, in terms of all the dynamics, and if the new government wins and this policy continues, the K-shaped consumption pattern is only going to accelerate. So, nothing to tell us right now. This is time to check out of the hotel. If you're there, stay put. If you're not there, get in at least, book for a couple of days and see how it goes.
Interesting. Yeah, I'm just back from Lucknow, and I mean, we were staying in Holiday Inn, and the staff was telling us there's so much of crowd coming in. I mean, it's chock-a-block completely. Ajay, I want to talk to you about the next generation reforms the market is trying to figure out would be coming from the government. Yesterday, we got a glimpse of that in the commentary coming in from Finance Minister. So much of work is happening. Will it be continuity of more of the same, or could there be some surprise which the street could be, watching out for going forward in the new term of Mr. Modi?
I don't think there'll be surprises because I think one thing the government very clearly has learned that whatever they've done, one can argue some are good, some are bad, has resulted in a very strong equity environment in the country. And that's a domestic equity environment, which has meant what? Which has meant that hundreds of companies which are struggling to raise capital, were living on debt, are now able to pay off the debts and go on the equity spree. And I think that's the greatest success story of 2023 is those hundreds of marginal companies who could never aspire to raise equity are raising hundreds of crores of equity. Now, what happens when you raise this equity? Your debt goes down, risk goes down in the system, your ability to build the market share goes up, and therefore you can compete in the market. So I don't think the government policy will change at all because whatever they've done so far has worked well for, as I keep saying, for most of the people. You're richer, you're feeling better, your consumption is better at this point of time, your equity culture is booming at this point of time. There's no need to change it because what you have done is taken the reliance of companies away from debt instrument and banks and move it to equity, and which is, it's not zero cost, but it is certainly zero risk money that your companies have. So I think fundamentally, for the equity market, the focus will remain. And that is why we said that the themes which relate to equity markets will continue to bounce, whether you're talking of AMCs, whether you're talking of depositories. I think they are going to have a much, much bigger run in the next 5 years. Because if the government supports more of this equity culture, and they've done it already by saying that unlisted companies also have shares in depository, for example. That's one of the things that they have introduced in legislation. Now, that is a precursor to opening up the market much more to private trade, etc. The fractional sharing of real estate. So I think fundamentally the policy will remain the same. And what's important for us to understand that debt return this year could become as good as index returns because this government, if it comes in power, is not going to borrow excessively. They don't need to buy out voters at this point of time, which means that the fiscal deficit going down, the greater chances of interest falling, assuming that the US interest rates also come in line, is for the Indian investors. So I think if you ask me personally, this year, 2024, gilt returns may even exceed the index returns on equity, given the fact that we expect in the second half, interest rates should start to come down quite substantially.
Okay. Thank you so much, Ajay, for joining in with us this morning on ET Now, talking about all the interesting sectors that you're looking at. That was Ajay Srivastava talking about the markets to us.